Assalamualikum OyaRahmatullahe OyaBarakatuhu. Innal hamdanillah wassalatu wassalamu ala rasulillah. Amma ba'd. Bismillahirrahmanirrahim. This is Muhammad Kamrul Hussain, Department of Business Administration, Metropolitan University, Sylhet. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. Today we will try to discuss the phases of portfolio management. Portfolio management is process encompassing many activities aimed at optimizing the investment of one's funds. 5 phases can be identified in this process. Number 1, security analysis. Number 2, portfolio analysis. 3, portfolio selection. 4, portfolio revision, and 5, portfolio evaluations. These are the 5 steps or 5 phases of portfolio management, or you can call it the how a portfolio management works. This portfolio management works by these 5 phases. Each phase is an integral part of the whole process, and success of portfolio management depends upon efficiency in carrying out each of these project. So this actually depends on efficiency carrying out each of these phases. So if these 5 phases are successful and very well, then the total portfolio management is very well. So actually the efficiency of portfolio depends on these 5 phases: security analysis, portfolio selection, portfolio revision, and portfolio evaluations. Now we will try to discuss these steps or phases one by one. First one, security analysis. The securities available to an investor for investment are numerous and of various types. Traditionally, the securities were classified into ownership securities such as equity shares and preference shares, and creditorship securities such as debenture and bonds. So securities available to an investor for investment are numerous and of various types. So traditionally securities were classified into 2: ownership basis and creditorship basis. So ownership basis, equity shares and preference shares, and creditorship basis we are seeing debentures and bonds. Recently, a number of new securities with innovative features are being issued by companies to raise funds for their projects. Convertible debentures, deep discount bonds, zero coupon bonds, flexi bonds, floating rate bonds, global depository receipts, euro currency, bonds, etc., etc. Some of these new securities which are now issued in the capital market to raise the funds. From this vast group of securities, the investor has to choose those securities which he or she considers worthwhile to be included in his investment portfolio. This calls for a detailed analysis of the available securities. Securities analysis is the initial phase of the portfolio management process. This step consists of examining the risk return characteristics of individual securities. A basic strategy in securities investment is to buy underpriced securities and sell overpriced securities. So you have to remember that this is the basic strategy of securities investment, that you have to buy underpriced securities and sell overpriced securities. As a like, if you were a businessman, then you purchase lower price and sell higher price, and between this difference is your profit. Such as a pen, you are a business of pen, you are going to purchase pen from the dealers or companies lower rate, and you will sell them to the customers higher rate. You get profit. So in the same way, whenever you purchase securities from the capital market, you have to buy underpriced securities which has the low cost or low priced securities, and whenever this price go high, then you have to sell them. But problem is how to identify underpriced and overpriced securities, or in the words, mispriced securities. This is what security analysis is all about. So in the total process can be told by security analysis. An investor would buy those securities which are underpriced and sell those securities which are overpriced. It is believed that notable cases of mispricing will be corrected by the market in future. Prices of undervalued shares will increase and those of overvalued shares will decline. So this is the rules. Later on we will see portfolio analysis. A portfolio is a group of securities held together as investment. We know it. Portfolio is a group of securities held together as investment. Investors invest their funds in a portfolio of securities rather than in a single security because they are risk averse. So we know that most of the investors all over the world are risk averse. That's why they try to make portfolio, and portfolio is a group of securities which will reduce the risks. By constructing a portfolio, investors attempt to spread risks by not putting all their eggs into one bucket. Thus, diversification of one's holdings is intended to reduce risks in investment. Security analysis provides the investor with a set of worthwhile or desirable securities from the set of securities, and identifiably large number of portfolios can be constructed by different set of securities and also by varying portion of investment in securities. So actually it is possible to create a large number of portfolio with the portions or with the amount or different segmentations. So here I said there is the different portfolio can be created. Here is said that indefinitely large number, that is cannot be countable. Each individual security has its own risk return characteristics, which can be measured by expressed quantitatively. Each portfolio, which is constructed by combining individual securities, has also its specific risk and return characteristics, which are not just aggregate of the individual security characteristics. The return and risk of each portfolio has to be calculated mathematically and expressed quantitatively. Later on we will see portfolio selection. Portfolio analysis provides the input for the next phase in portfolio management, which is portfolio selection. The goal of portfolio construction is to generate a portfolio that provides the highest returns at a given level of risk. A portfolio having these characteristics is known as efficient portfolio. So you know that efficient portfolio, which has the great return and minimum risk. So maximum return, minimum risks, that create the efficient portfolio. The inputs from portfolio analysis can be used to identify the set of efficient portfolio. So there has created too many efficient portfolio. From these efficient portfolios, the optimal portfolio has to be selected for the investment. That is the portfolio selections. So there has the number of portfolio. From the portfolio you have to select the efficient portfolio. From the efficient portfolios you have to select the optimal portfolio. So what is this? So that is matter is, first we are creating portfolio. We are creating portfolio. Portfolio, what is portfolio? Group of securities. And this group of portfolio, from that group of portfolios or a number of portfolios, you have to select efficient portfolio or efficient portfolios. From these efficient portfolios you have to select the optimal portfolio. That is the portfolio selections. So at first you analyze securities. At first you analyze the securities, and from the securities you create the group of securities, create the portfolio or portfolios. This group of portfolios or a number of portfolios, then from this number of portfolios you have to take or you have to select efficient portfolio. From the efficient portfolios you have to select optimal portfolio. That is the portfolio selection. After that there arise portfolio revision. Having constructed the optimal portfolio, investor has to constantly monitor the portfolio to ensure that continues to be optimal. That is the portfolio revision. So you select optimal portfolio, then you have to revise, or you have to monitor to ensure this continues to be optimal portfolio. As the economy and financial markets are dynamic, changes take place almost daily. As time passes, securities which were once attractive may ceases or cases to be. New securities with promise of high return and low risks may emerge. That means, so every day there has a possible to change the result. We are thinking these securities are well, but tomorrow we will see the new securities come into the market, and that's are very nice. So new securities with promise of high returns and low risks may emerge. The investor now has to revise his portfolio in the light of the development in the market. That is the portfolio revision. The investor now has to revise this portfolio in the light of development in the market. This revision leads to purchase of some new securities and sale of some of existing securities from the portfolio. So this revision leads to purchase of some new securities and sale of some existing securities from the portfolio. So that is very clear to us that is a very good nature of the market, that it is changing. So whenever it is changing, then you have to conscious, you have to sell the existing securities and you have to purchase the new securities which securities have promised to you more return with low risks. That is the portfolio revision. Understand? The mix of securities and their portion in the portfolio changes as a result of revision. Now last one, portfolio evaluation. Last point is portfolio evaluations. The objective of constructing a portfolio and revising it periodically is to earn maximum returns with minimum risks. Portfolio evaluation is the process which is concerned with assessing the performance of the portfolio over a selected period of time in terms of return and risks. This involves quantitative measurement of actual return realized and risks borne by the portfolio over the period of time. These have to be compared with objective norms to assess the relative performance of the portfolio. So here is the evaluations. So you have to evaluate your portfolio to have the maximum return with the minimum risks. Portfolio evaluation is useful in yet another way. It provides a mechanism for identifying weakness in the investment process and for improving these identifying areas. It provides a feedback mechanism for improving the entire portfolio management process. So that is the portfolio evaluations. It is a mechanism for identifying the weakness of your portfolio and improving these identifying areas. Actually, this is the feedback mechanism for improving entire portfolio management process. So finally, portfolio management process is one ongoing process. It starts with security analysis, proceeds to portfolio construction, and continues with portfolio revision and evaluations. The evaluation provides the necessary feedback for desiring a better portfolio next time. Superior performance is achieved through continual refinement of portfolio management skills. So this is all about the phases of portfolio management, or you can call the process of portfolio management. This is the 5 process or 5 step of portfolio management. So first one, security analysis, then portfolio analysis, portfolio selection, portfolio revision, and portfolio evaluations. These are the 5 process of the total portfolio management. Thank you. This all about today. Stay home, stay safe, try to maintain a safe social distance, try to wash your hands frequently in a day. Subhanaka Allahumma wa bihamdika ashhadu an la ilaha illa anta astaghfiruka wa atubu ilaika. Assalamualaikum warahmatullahi wabarakatuhu.